Everybody got a mic? Taylene, that'll be yours, and then we could easily. Hey, Hunter Conference. That was freaking lame. Except Chris down there, he understands enthusiasm. Let's try it again. Hey, Hunter Conference. All right, we're getting better. But I think once we get into this panel, you guys are going to be so much more excited because today we're breaking new ground. We're going to do brands and owners, and we're not doing any of these 90-degree perspectives or 180-degree perspectives. No, we're going to go all the way around, 360-degree perspective. Hopefully we won't start out where we began because then that will be a useless panel for all of us. All right, let's get this thing started. On the far side, we got Mr. Matt Marquis, CEO of Pacifica Hotels. Let's hear it for Matt.
Begging for the applause.
Yeah, Matt, that was really unfortunate over there. Let's see if there's more love for our next guest over here, Mr. Todd Turner, CEO, OTO Development.
Thank you so much.
I don't know. Let's find out. Next up, the incredible Taylene Staub. She's a brand leader with Home2 Suites by Hilton. Let's hear it for Taylene. Hey, Taylene, it looks like you paid off a lot of people to not applaud for those guys over there, for sure. All right, then, of course, Mr. Dupree Scoville, Managing Partner and Chief Investment Officer of Woodbine Development Corporation. And then the man I've been working with here for a lot of years doing this panel, Mr. Jim Tierney, SVP Development and Owner Relations with Hyatt Hotels. Let's hear it for Jim. All right, so thanks, guys, for doing this with me. And listen, if y'all out there have some questions, please raise your hand or throw tomatoes at me or something, get my attention. I'll come down because really, y'all know me. I could talk, but for us to be really successful, I want to make sure that we're addressing the issues that are most important to all of you. So I'll introduce myself real quick. I'm Glenn Hausman. I host a podcast called No Vacancy. So I get to talk to all the top people in hospitality every single day. And one of the really cool things is that I get to go to all of these events throughout the country and really learn from the best people in the business. That's given me my own 360-degree perspective. So I'm going to go over to Matt and start with Matt. And if, you'll notice his amazing sneakers. And if you want to learn more about that impressive sneaker collection over there, check out our episode of Friday Night Audit, a happy hour comedy show that we do every week where he talks all about that particular issue. So
It's my best interview in the business ever.
Right, seriously. Really, it was at least the most interesting interview I've ever done. So Matt, we'll start with you. One of the things that I found interesting is that you have that independent mindset, but at the same time, you appreciate what brands can do for you. You kind of had a little bit of a change during COVID with your philosophy. Could you explain why you've kind of gone more all in on brand partnerships?
Absolutely. We would be looked at like a Manic owner. We've debranded and then rebranded. We had a huge, not huge, a good size of our portfolio was independent prior to the pandemic. And during the pandemic, we all sat back and kind of reassessed what we were doing in life. But we decided, and we had been kind of looking at some of the soft brands and running the models, and those models are great. And you kind of look at them and you go, yeah, but this is what they want you to do. They want you to kind of figure out that it makes sense. But we continued to run them, and then we said, we're going to test one. And so we tested one, and it seemed to work out. It was playing out well. And coming out of the pandemic, we felt there was a need to have credibility. We had done this in Hawaii with a major repositioning of the King Kamehameha Kona Beach Hotel when we put Marriott on there. And part of that was, the reasoning was, people get one chance to go to Hawaii, they're gonna go where they feel comfortable. And a brand like Marriott, Hilton, Hyatt, make people feel comfortable when they're gonna make an expenditure like that. We applied that same logic coming out of the pandemic, saying people want cleanliness. They want sanitization.
Yeah, speak for yourself.
Yeah, yeah. not me personally, but people wanted that. They wanted to feel safe. And while we had a great reputation in the industry, we're still an independent group. They're like, maybe we're going to stay with the brands coming out of COVID and the pandemic. So we went with our good friends at Hilton, and we brought in some of their soft brands, and it's been a tremendous success in our portfolio. So we love both now, and we kind of battle our own selves, and okay, well, would this one do well as a soft brand? I don't know. It's already doing great. So it's a fine line you play.
Yeah, and I think the development of soft brands has really been a great fuel injector for a lot of hospitality businesses over there. I think the first brand, they're not being represented up here today, came around in 2009-ish or something like that. I believe is a direct result of the Great Recession and the need to kind of expand portfolios. And what's really been interesting about that is right now we're kind of at this interesting nexus where people want independent hotels, I think, more than ever, yet it's set against the backdrop of wanting to be comfortable with a brand promise. And that's why I love these soft brands, because they really straddle both. Jim, how are you thinking about this particular issue?
Yeah, Glenn, for us, I think we see growth coming really in three
Right.
places. Soft brand's one of them. For us, it's our lifestyle space. And then where I sit most of the day is in select service. So we see it in those three areas, kind of equally, quite honestly, but for the same reasons Matt touched on, right? The ability to maintain your identity, but just plug into a little bit larger reservation system and support system.
Yeah. Now, Taylene, I know that you're the global leader for Home2 Suites, but you've been with Hilton a long time. You understand the perspective. How is the offering soft brands really complement the overall portfolio, and maybe even lead into those folks purchasing products from you?
Yes, I mean, we look at a lot of ways that owners can come into the Hilton system. So sometimes it's through the soft brands where, you're finding that there's extra value in having that engine and that consistency, reliability behind you. So that helps bring new guests, new owners to us. But then we also look at maybe entry level, like, when we launched True, that was supposed to be the entry level brand into Hilton. And now, True is kind of punching up against its weight class. And so now we've introduced Spark and now LiveSmart. It's great for not only new owners to kind of come in and work with us, but certainly reaching a ton of new guests that we weren't serving before. So, other brands are doing that too.
Right. Todd, do you want to add something?
Yeah, our background, we started Extended Stay America in the mid-'90s and built 475 of those, created a brand of our own. So we started off sort of being a creator of a brand and sold that in 2004 and started OTO with the purpose of going to build Hampton Inns in California, because there are more Hamptons in South Carolina than there were in California when we started 20 years ago. So that was kind of our vehicle into the franchise development business instead of our own brand. And we've been huge believers and really been astounded by the power of hard brands, simple things like Hampton Inns, that if you put them in the right place and build them right, you can produce phenomenal results. We've had great luck with Hilton Garden Inns and done a lot of ACs and Hyatt places, and big believers in that, because we know that the main drivers of why people select the hotels they select is location and price and reliability. And those hard brands, while my wife is a hotel snob and won't stay at a Courtyard, it's a hell of a thing to own a Courtyard.
I saw Taylene smile when you said,
Yeah. I mean,
what's that, a Courtyard?
but and she's kind of kidding when she says that, but not really. So, but we have one soft brand. It is a Tapestry on the sand in Fort Walton Beach. It was a Best Western that we spent a lot of money and transformed physically, and we've had a great experience with that. It's surprising me at how its contribution of Hilton Honors is 70% contribution, which is bigger than I expected, and it's been open about a year. So we're open.
Did you say 70?
Yeah, 70% of
That's
the guests
phenomenal.
are yeah. It's a 100-room hotel, so it's a small box, but it's producing for us that way. But frankly, if Hampton had been available in that market, we would have made it a Hampton probably, and done great with it. We've got a Hampton in Key West that's over $300 RevPAR. So you can do well with those hard brands if you do them right. So that's our focus is just finding the right fit for the site and the market and the location.
That's excellent. Now, Dupree, I wanna talk to you a little bit because your family's been developing hotels for a really long time, right? And you started more with traditional brands out there, and you've kind of transitioned away from that. Could you share a little bit with everybody about what that philosophy was all about and how maybe it unlocked potential for your company?
Sure. Well, we started with Hyatt 45 years ago. Nice work. And that was kind of the.
Did Jim sell that from
That's right.
first
That
grade
was
class or something?
sponsorship, Right there. That was good right there.
Dupree just got a break on his franchise
I'm
fees.
working on a good ramp for a deal right now. No, Hyatt was the kind of partner we started with. Actually, mainly because we came to Atlanta, saw the Atrium Hotel here, thought that'd be interesting to have in Dallas, and then built Hyatt Dallas from Union Tower there. And then we went on to do several thousand keys with Hyatt. When my brother and I got involved, then it began. We started to think about that we do need diversity across that, and so that's when we started building with Hilton and Marriott as well. And now we're about a third. But what started these big convention boxes, which is where we made a name for ourselves, and then in the resort space, we really figured we had to do what OTO did, and that was get into a lot of the select service stuff as well. And a lot of times in our space, you're kind of a niche player. You're either in select serve or you're in full serve. We've tried to create some diversity across that, and not much to add on the soft brand space, except that I think it does, in many ways, it helps when you have developed trust with a brand where they know what you're going to deliver, and so you do have a lot more flexibility within those independent and soft brands to be able to do what you want to do. So we've been able to have some success in those categories. I think it is one of those things where you kind of pivot. I mean, especially when you think about the extended stay platform that both Hyatt, Hilton, and Marriott are launching right now with Hyatt Studios and Studio Res and those brands. That's going to be a really interesting, kind of frontier of growth that I think will be another end of the spectrum for hotel brands.
For sure, and we all know the extended stay market has really soared in the last number of years, and all the major players are putting out product in order to connect with consumers in that way. But a lot of times, Jim, the strategy behind one of those properties is very different than the strategy of soft branding a hotel, right? Which is a totally different concept. What are your owners really looking for when it comes to building an extended stay property in the Hyatt family, for example?
Yeah, Glenn, for us, it was about, quite honestly, a white space, right? So, prior to 2004, 2005, we just had full-service hotels, and we'd been that way for 50-plus years. In 2004, 2005, we get into select service with Hyatt Place and Hyatt House.
Just hold on one second there to give people who are younger in the industry. I don't think select service really took off in a meaningful way till the late 1990s. That's when Hilton bought Promise and companies like that really unlocked all the changes that we're seeing now in hospitality with myriad brands out there. Sorry, please continue.
No, that's right. So for us, and the reason I'm telling the story is you then fast forward 20 years when we decide to now move down into upper mid-scale with Hyatt Studios. It really was about being in more locations, in more markets, right? Talene, you touched on, right, the ability to cater to more guests where we just didn't have a fit.
Right.
And then it was also a fantastic on-ramp for new owners who then would come in maybe at the studios level, right, work their way up, do Hyatt Places and Hyatt Houses, go on to do full service, some of the lifestyle stuff and soft brand stuff. So for us, it was really about a brand that more people could do and in more locations. It's something that they'd been asking us for years.
That makes sense. And again, going back to the whole strategy of having, different brands for different types of stays. Matt, you've been focused very much on that full service market. Has extended stay or stuff, intrigued you at all?
It's a very timely question. We're actually right now looking at an opportunity with a infant brand and coming in and being one of their capital partners. So it's a different position for us. It's more of an asset allocation kind of opportunity for us. So we won't be operating. We won't necessarily even be driving the engine, but we'll be part of it. And we're excited about that. And that's kind of how we're evolving. I think what's interesting is as I was thinking about all these brands, it would be interesting to, I don't know, you take the top 4, 5, 6 national brands and all the different categories they have now you know, it used to be, we touched on it, and it's even, we're even dating ourselves up here on this panel by calling it select serve, because now I think the term is focus serve because it sounds better. But the reality,
It sounds a lot better.
yeah, it does.
Limited service sounds like you're getting screwed.
But nowadays, you know, you used to do an independent because there was nothing, you wanted to do something and there was nothing in a brand that fit that. Now you can go to the brands and kind of look around and say, oh, you know, that kind of looks like this, a Hyatt House or a Hyatt Place, or, you know, I could do a Tapestry. A Tapestry, you have a little more brand, but there's all kinds of things you can do within the brands, which is really interesting, and I think it's exciting.
Yeah, that makes sense. Taylene?
No, I was just going to say, I think in today's world, it's even better to have the soft brands. Guests want consistency, quality, but they also want like something free, right? They don't like to be original. And so they get to have that original stay without having the risk. They don't want risk. Service is tough. And so we all know it, and we are doubling down on getting back to the fundamentals of service. And people want consistency, and there's so much inconsistency right now, but just having a brand affiliation, whether it's soft or a hard brand, I think really helps in that confidence. And if you know the numbers are super high for loyalty, you're getting that. And for us, like Home2, we ran $141 ADR for 2023. There's a ton of extended stay business, per diem, relocations. You know, Isaac leads Live Smart, and his brother's Air National Guard. You could not stay at a Home2 or a lot of other brands, and we're just like giving that honors business away. Like that loyalty just has to go somewhere else. So it gives the guests a lot more options too, and comfort.
Yeah. When was Home2 introduced?
It launched in 2009, which is a terrible time to launch a brand, by the way.
Yeah. Well, there's another company out there that always seems to launch a brand, and then there's a global crisis, like right after that happens. But it's really funny, and I'll admit, when you all introduced Home2 Suites, I'm like, they're really coming late to the game with this particular product. I think that was like the most wrong I've ever been, because in retrospect, it turns out that y'all were pretty much early entries into that category, and really helped set the tone for what people are looking for in that particular brand, which is why I think it grew so much. Japri, how are you thinking about the mix of properties in the major brands, and how that may help or hinder your ability to be successful in your business?
If I was being pessimistic, I would say I think one of the brands not represented has 30-something flags, right? I mean,
Yep.
It becomes really hard to find how those swim lanes is often referred to, how those don't blend.
Yeah.
And so as an owner, I think we have to really start to think really hard about, okay, where is the customer? How are we segmenting those? Where is their market share that can be captured? And I think the white space that exists, in our view, right now is really in that extended stay, kind of more the economy extended stay, which is just below Home2. So maybe it's 3.5 or Home4, but there's some space in between Home2 and Extended Stay America that I think is where there's white space in the market, and that's where we feel like we can capture some value today. Of course, if we go into Dallas or Austin or San Antonio or wherever, thinking of Texas cities, it's a little bit harder because you do have so much brand presence. So we have to be really thoughtful about where we think the specific brands within those categories can compete, and that's sometimes where independence ends up making sense, like complete independent.
Right. And what you're saying makes a whole lot of sense. And it was probably 10, 12 years ago where the major companies started adding by whatever name of the company it is, because I think that was really reflective of a strategy that's paid off in the long term. When you have dozens of brands under it, I think any of us would be hard-pressed to remember what all of the brands are in a particular brand family at any given moment. Not that you don't know them, just hard to recall so many off the top of your head. So customers act in a very different way than all of us think that they should here. So they don't really understand the distinction between certain brands. So by having the by Hilton or by Hyatt, for example, I think really clarifies it and opens up the market. But then again, Todd, does something like that cause confusion, do you think, for consumers, for owners, or is it just a plus when you're working with the brands?
The affiliation with that consistency is a plus. I think people would, earning points and using points. We've got a lot of properties on beaches where people spend a lot of points, so that's a big driver of demand for us. Provides headaches when we have to get to threshold, which is a different story. But these ecosystems and the brands that we affiliate with, we do that for a reason. We don't affiliate with all brands out there. We like the ones that we are associated with are the best in the world. And travelers know that they're the best because they hold the standards up and they know what they're going to get. It's a reliable experience. But we also know that the brands that we affiliate with, Hilton, Marriott, and Hyatt are our primaries, and there are 60 flags, I think, in those different organizations. And their job, y'all's job, is to do more of them, right? So, Jim, that's what y'all do. So when we're looking for a place to develop or invest, those barriers to entry are important because we know these folks are doing a great job of finding new people to develop these new brands that are being created. So we always have to be thinking about how protected can we be when they're doing their job to grow their company.
Right, because the second someone goes, oh, look, there's white space, we got another new brand in the market.
And on a sub-market basis, I'm thinking more than anything about protecting the demand from getting eroded every time a new hotel enters the neighborhood.
Yeah, and that's what we're seeing right now with the extended stay market. As that starts to mature, the reason we're seeing different brand proliferation is because you no longer want to have a one-size-fits-all type of a product. So you get to different price points, you get to different experiences, all of those kinds of things over time.
Yeah, if I could just touch on something that Todd said, right? The desire to grow is there, but we still believe that there is a thoughtful and intentional way to do it, right? Even with the launch of brands, right? For us, we won't look at a new brand unless we firmly believe it meets an unmet need of a guest and an owner, right? It has to show differentiation or distinction internally and within the industry. So again, I think growth is important, but there's a right way to do it.
I was just going to say, I was on the True brand when we had 50 hotels, and every day I was hearing, we need to add microwaves, we need to add coffee, we need to make it more like Hampton.
Right.
And owners...
The whole point was not to be like that,
Well,
right?
that was the point, but owners got uncomfortable with that first initial response. And I said, it's great that they don't think it's like Hampton. And it's great that the Hampton guest stays with us and maybe doesn't come back, because that means we've created something to tap into something that wasn't there already. And now, over time it's ramped up and it's doing fantastic. We have over 250 open. But I feel like there's if it's different and it's uncomfortable, that's good, and you're performing well, you shouldn't have a one-size-fits-all brand, because that's not good for the customer. But owners like it.
Right.
It's simple. So that's a little bit of good tension, I think, that belongs in our ecosystem.
Yeah, so you've
it's
gotta be-
probably 50-50, right? Some want it prototyped, the other want customization, right? So like you, we're favoring flexibility, right, to tailor the product based on market and guest needs, and we think that's kind of the winning formula.
It's funny, though. We had the King Kamehameha Kona Beach Hotel, Courtyard by Marriott. You think about the national or the state fish of Hawaii, the Hunahuna Nakanaka. It was like our name was longer, and it was interesting when we had redone the hotel as an independent, and then I kind of hinted at the story. We decided that we needed a national brand, and the only thing really available at the time was Courtyard, and then this new kind of Renaissance kind of thing, and we were like, we don't know about that, and so we went with the Courtyard. 465-room Courtyard with the largest luau on the Big Island. It wasn't a Courtyard, but it got us in the system. As we go through the brand standards, one of the Marriott people working with us said, hey, you got to have these pods in your lobby. And we're like, we have an art gallery with one of the most famous Hawaiian artists. I mean, we're not going to put pods here. And they made us do pods. Later, I'm walking with the senior Marriott executive.
Yeah.
And he looks at it and he goes, why the hell did you guys put pods in here? And I'm like, because you made us.
Yeah,
So
right.
I think there, sometimes the silos need to kind of communicate upward and downward. When you're dealing with, like you said, a more customized, product within a brand, or within a submarket of the brand. Because you can really overspend, and then you have the relationship between the brand and the owner is so important, and I'm not sure all the brands understand that. That personal relationship and how they're treating their owners and those kind of things really does make a big difference on future decisions.
Yeah, it sure does. Jim, I want to come back to you in a second because you're owner relations, but Dupree, I know you've been wanting to say something for a little while over there.
No.
He doesn't want to follow that one.
No. I'm thinking about what I could say, the right way to say it. I think what you said about the relationship side is important. From a brand and owner perspective, at least what we've experienced is that there often is a rigidity and a dogma that comes with how the process works, and it does forget about the relationship. And not with all brands, but I think that's where there is going to be some delineation where brands are gonna move and gonna have a lot more traction with developers, because at some point, and I'm really curious to get Todd's opinion on this, but at some point the owners and the developers go, you know what, that's just not worth it. Like there's too much angst, there's too much my way or nothing. And so I think that creates an opportunity, at least it has for Woodbine, to say, you know what, there's probably brands that we're just going to be able to grow with in a more aggressive and faster way, just because life is too short.
Right. And I think we've really cut to the heart of friction that's between brands and owners that are out there. When you're thinking about what the brands want to do, you want to do what Taylene is talking about, protecting the integrity of that. Because if you stray too far from what the meaning of the brand is, then you've lost that equity with the customer base. But on the other hand, with what Matt said, if you're not really taking each thing individually and thinking through it, you wind up with something that just wastes money and doesn't move your financial needle at all. So it's really an art and a balance trying to pull all of these things together. And I guess, Jim, that's why you're doing franchise relations and stuff like that as well.
Yeah, Dupree, if you ever get to that point with some of the other companies, just give me a call, okay?
I have.
Listen, I think that for us, our relationship with our owners is critical, right? It helped us get through the pandemic. We created a franchise and owner relations group,
Right.
which is solely focused on the hotels and the profitability. But then we lean heavily into our owners advisory committee, our franchise advisory board, right? The launch of studios, quite honestly, was done on the backs of developers, right? This was truly developed through the lens, right, of folks like yourself who made the product better. And that's how we feel, right? We listen, we act, and we're able to bring forward our purpose.
Right, and if you want to learn a little bit more, I did an interview with Paul Daly, who's the global head of franchise owner relations with Hyatt. That interview should be dropping tomorrow, so check that one out. Taylene, I know you want to add something more?
Yeah, I was going to agree with everything you guys said. I think something that's maybe a byproduct of, and I'll speak for Hilton because that's what I know, when we launch brands, it's usually we're developing them ourselves. What people might not see is it forces us to get our house in more order. So there isn't as much chaos for the owners because in the way we're organized now, so we joke internally, and this is so inside baseball, but like we're called the focused in all suites category is like a mega category because we all report to one person. But what it's forced us to do, it's like when your kids don't get along and you put them in the same room and make them sort it out. Like we have to figure out what's the 80% that we have to leverage that's common across all of our, how to leverage Big Hilton so that, because owners were telling us, if I do something for this brand, now I got to start over and do it for this brand. When you guys are like 2 degrees apart, make it the same. And it's taught us to, like, every time we launch a brand, we got to clean up inside and we got to sharpen our own game for each brand because we don't want the other. We're still competitive amongst ourselves,
Right,
with
totally.
the brands, right? So, like, I want to make sure Home 2 is in a great position with LiveSmart. So and with Spark, we're moving the fastest conversion brands. We have to get our processes faster. So it makes us get more in shape. And you all won't hear that or see it, but that's kind of what's going on behind the scenes. And owners are not shy about telling us when we're hitting a wall or doing silly things, which is great, and we value that and appreciate that. As long as that's being taken into consideration, you're still protecting brand integrity. So I feel like when you've got all the ingredients together, it works really well, but you got to work hard to make that communication keep going. And
Yeah, that is absolutely for sure. And one of the things that I think has been fantastic that the hospitality industry has done over the last 15, 20 years is really getting close to owners when developing new prototypes and new brands and really understanding. I think one of the Hampton prototypes was the first real brand that I remember earlier in my career where they're like, we brought owners in to really get an understanding of what it does. Before that, everything seemed to be done by fiat. You will do this or whatever. But as part of the learning curve for breaking into the select service business, I was thinking was engaging owners in a more meaningful way to give them a product that they are really looking for so they could be more successful in the businesses, which creates that virtuous circle of them buying more products and allowing you to then develop more products within the market. So it's been a very interesting growth period, but Jim, when you're thinking about that, how involved are your, owners in helping develop concepts, brands, amenities, and services?
I think I touched on it, Glenn. Critical.
Yeah.
Right? The pandemic, while difficult in many ways, really allowed the brands to hit the hard reset button, right? So we relied on that feedback, quite honestly, to make sure that the brands were evolving, right? They're still in compliance with the integrity and the intent of the brand, but everything that we've required since has to make financial sense.
Right.
Right, so you think about extending renovation timelines if the hotel is in good state. You think about providing, right, services from the core, right? We can do them probably cheaper than burdening the hotel with central sales, revenue management, field marketing, right? And you continue to build out tools. All of this is stuff that came to us from the Owners Advisory Committee, the Franchise Advisory Board, and really helped shape the operator standards moving forward.
Dupree?
Well, it's going to be a really interesting experiment because, at least in my career, this is the first time that the three bigs are launching the same brand at the same time, right? I mean, in every other category, it's been somebody led, and then there was a carbon copy that the other brands then came with. In this case, with the three kind of economy extended stay brands launching at the same time, it is going to be really interesting to see what that does to the market in terms of what demand there is, what the differentiating factors are, what developers get behind. It's kind of the first time there's been a race where everybody starts at the same line.
I just want to announce I'm starting my own extended stay brand. Project Hausman is the working title right now.
Me
Jim,
too.
sorry.
I was just going to say, right, we all came out at the same time, but I think Live Smart and Studio Res are probably stronger competitors. We're going up to mid-scale to upper mid-scale. So again, depending upon whether you call it premium economy or lower mid-scale, I think that's where, correct me if I'm wrong, Talene, Live Smart and Studio play, and we'll play in that kind of mid-scale to upper mid-scale range.
Yeah, that makes sense. Matt?
I just thought it was funny that it shows the parsing of our industry right now. Premium economy is just the most excellent oxymoron I've ever heard.
Yeah.
That's why I said it, Matt.
Totally.
Tongue in
And
cheek.
I think I saw a wink when you said that.
in the spirit of Ed Bastian, I do love those Comfort Plus seats. It gives me that premium.
Yeah,
economy.
they're right
Makes
in
me
there
feel
with
a
that.
little bit special, but not so special that I get too big of an
You're
ego.
wondering if it was really worth it.
Yeah. All right. So, Jim, you mentioned the hard reset that we have. And if you all, I don't know if you guys remember this, but 4 years ago, right around now, we were not here. I was too busy creating a drinking problem for myself because of all the shock of going through everything. But, Jim, you were absolutely right. It was a hard reset. It gave everybody an opportunity to rethink the way that they're going to be doing their businesses going forward without having to be subject with having that light shown on you if you're going to be a failure. Because everyone was able to just go, okay, and kind of move on to it. Todd, how do you think the industry has become better off when it comes to brands and ownership relationships because of such a life-changing crisis for all of us here?
That's a big question. On the operating side, I think the flexibility that we all had as owner-operators to offer fewer things that required fewer people to do them was a great sign that, yes, we have a customer promise to provide great service. And once we got out of the real scary part, there was still the flexibility to say you don't have to do housekeeping every day in every room. That was great. They're pulling some of that back now. It's every other day generally now, which might be the right spot to do it. But if you want more, you can ask for more.
Right.
I think if you wanted to pay for it, that'd be fantastic. But that flexibility was critical for all of us to sustain, and indicative of the fact that the brands do listen to us, and we, partnership is one of our guiding principles in our company, and these brand friends are friends and partners, and we know how this works. It's symbiotic. It's got to work for both groups, right? Or it's not, or it's going to collapse. So that part and the communication pieces and the initiatives that the brands launch to make guests feel more comfortable even though the stickers on the doors at Hilton were kind of dumb and
Right.
required a lot of repainting and things. It was
too
probably
sticky.
no one knew what the hell's going on, so you had to do something, and they did act and did the best that anybody knew to do. So that was again just kind of locking arms and say we're going to have to walk through the valley together, and I love where we've come out on it.
Right. So for the last few minutes that we have of the panel, let's look forward. Now, I know everybody's here because it's a financial conference, so I just want to spend a few minutes going into development and how it relates to owners and brands and stuff like that. One of the things I've been hearing about is interest rates are so high. How can we get anything ever done? And I told these guys I was going to mention this, but before the Great Recession, interest rates were higher than they are today. And people weren't sitting at the Hunter Hotel Investment Conference in 2007 saying, interest rates are so high, I'm never going to create a hotel ever again. It's just not possible. But I think what happened is, after that, we had a knee-jerk reaction, lowered interest rates to basically near zero for so many years. It's created a generation of hoteliers and executives that are emerging that don't understand what that operating environment was like. I'd love to hear you, Matt, tell those people out there why they could still be successful working with the brands and investing in new products at today's interest rates, even though there's a little bit of shakiness with how it's going to go down.
I'm old enough to remember the stories and remember a little bit of the high teens interest rates.
Yeah,
back
I
in
mean,
the
when I was a
70s.
kid, it wasn't weird. It wasn't weird for home mortgages to be like 18, 19%, right?
That's exactly right. Values have adjusted with those rates, and I think that's one of the challenges. Is that we all look at historical value and what we cost, whatever it cost to develop or something like that, and we built to a certain level of operations and financial structure to where, okay, it makes sense at this. But if you look at where we are, everyone's talking about trying to get transactions done. The reason why there's not a lot of transactions is because the values haven't adjusted to the interest rate environment. And again, part of that is because we have a generation of people that are used to almost zero interest rate, a cost of money from the banks that is absolutely ridiculously low. And so, we'll see how that plays out. I think there's a lot of uncertainty with regard to development, and Dupree is probably the premier developer here on the panel, and OTO. But the reality is that you want to control what you can control in this business, and there's a lot less control in today's climate.
Right. And Jim, let me throw this to you real quick from the brand side of things. Since you're working with these people every day, selling through franchises, are they getting through to the point now where they recognize this is I hate to use the phrase, the new normal, and are now able to compensate for that and move forward? And maybe another layer is it's killing deals anyway that would have been rejected by your desk anyway.
Yeah, I think the short answer, Glenn, is deals are getting done. They're taking longer, right? I think people are getting all their ducks in a row before they move forward. I think there's a general acceptance that the brands understand how hard it is, right, to get shovels in the ground. So we're being a little bit more flexible on development timelines, but the deals are absolutely getting done. I think, right, that's why you're also seeing a little bit of emergence in economy and mid-scale, right? A $15 to $20 million price point is a lot easier than a $25 to, say, $40 million price point.
Todd?
Glenn, you referenced what the prior peak of interest rates, but the cost to build a Hampton Inn
is
in a
much
good
higher
market
than
was
that.
$90 a square foot. Today it's $300 a square foot.
Woo!
So that's a huge difference in basis, and basis matters. So it's a math exercise. What we all look at every day, it's math, and it has to work. So that's is the biggest challenge. On top of we were used to 0%, now it's gone up 500 basis points. That just adds to ratcheting up the inputs, and operating costs, of course, have escalated rapidly. Insurance, so it's getting squeezed at every point, right?
Yeah,
So
I did a
it's
panel
tough.
just 2 weeks ago at another financial conference all about that ridiculousness. We're actually going to be running that from the Click conference very soon on the No Vacancy Network, so look out for that as well. Taylene?
Yeah, I was just going to say, well, Hampton launched our new North American prototype today. But that cost line is, the number one thing that we're looking at. It's not, how can we make the costs very, relatively flat, stable, maybe even go down in some areas, and FF&E we're going down, but really operationally, like we know labor has to be part of the math. So are we doing programs that cause more labor? We're looking at that. It just changed the way really fundamentally that we've been looking at everything we do from a brand perspective. But, you know, and then you look at brands like Hampton, which is, we're gonna open our 3,000th Hampton. It's 40 years old this year, and it's still running, you know, most 5-star reviews, you know, top hotel franchise in Franchise 500. To be still relevant after 40 years is kind of insane in this world where we're talking about new brands every conference. So you got to give kudos to what that means for the people that are developing them and the great job that they're doing, the operators that we have, the team members, and the guests, that consistency. So I know we talk a lot about the new brands. There's so much room still for the stable legacy brands that guests love. And so, you know, 800 Hamptons in the
Right.
pipeline, that means like they're still going strong. So while we talk about the new brands, there's still like the bread and butter there too.
All right, so Dupree, let me pull this all together and get you to take it a step further. If we're in an environment where it's getting more expensive to build hotels, it's getting more expensive to operate hotels, and in my opinion, I think we're getting pretty close to how much consumers are going to be willing to pay for specific hotels out there. How does that inform your future development?
Switch to industrial. I mean, I don't know. There's not a great answer. I think what the reality is that I think the answer to kind of all of these issues is the developer has to take more risk. I don't think there's any way around it, because institutional equity, they have long memories about the way returns have always been,
Right.
and the risk they're willing to take on development. And so what oftentimes is required of the developer is to say, we have to pioneer a new brand. I mean, it's not that expensive for Hilton or Hyatt to do that. It is for us, because we're saying, look, we're partnering on this, but at the end of the day, we're taking the financial risk to get there. And so we're having to buy land. We're having to look at developing all equity. We're having to look at saying, okay, we're going to advance the plans much farther than we normally would have before we have an equity partner on board, because it wouldn't make sense to go get debt today. So instead, we're going to spend $1 million or $2 million on plans and entitlements and permits to get it to the point where, okay, now we think capital markets will have settled here in 6 to 12 months. Now it makes sense to get a loan. So to me, it really does. It becomes a risk-adjusted return, but most of that risk is borne by the developer. Now, if you're a developer, that's what you're used to. You have a high tolerance for risk. But there is a point where you're kind of going, man, it feels like more and more and more of my chips are going all in before anybody else's is.
Yep.
And that's frankly just in some ways, maybe it's the frog in boiling water thing, but we just kind of keep going. We kind of keep going all chips to the middle.
Yeah, Matt?
You know, it's already been said here, and it could be the theme of the post-pandemic hospitality industry, is life is too short. And it's true, you know, with brand relations, with development issues going into it, and you start seeing them, and you go, life's too short.
That's not how I felt when I got up this morning.
And it's different, you know, if you're a young developer and you're trying to get your first couple deals and you're willing to take those risks, and you maybe have a lot less to lose. But for, you know, older, mature companies to like go out and take those risks, it's hard. It's hard because you don't want to have institutional equity, and partners have very long memories, and so you want to make sure you're making good bets. And so I think it's a challenging environment we're in right now.
It sure is. All right, let's move into some final thoughts. Matt, let's start with you and come on down from there.
Life's too short. Buy sneakers. No, you know, I'm excited. You know, we're excited about this new opportunity in the premium economy lane that we're looking at. We continue to do what we've done all along, which is kind of this boutique coastal aspect, and we're bringing some of that to the rest of the nation with some of our stylings, I guess, with some of our boutique and soft brands. We're looking to expand across the country. So
Excellent. Todd?
Our space that we've been committed to for the past probably 14 years has been what I'll give you another term, trophy select service. I heard that from Craig Ballard. I don't know where you heard that, but we have the collection of 43 hotels in fantastic submarkets, but they're select service brands that are built in a way that sometimes overbuilt, overdesigned, over-amenitized, but they can look up and rate against some of the full service and luxury peers, but have that consistency and that fire hose of these brands coming to them. So that's where we are and where we're going to stay probably. We we've done the economy extended stay before with creating that business back then, but we kind of like where we've settled now. We're going to stay up there, but it'll be fascinating to watch how that development unfolds in the new segment.
Awesome. Taylene?
People are traveling. The hotels are busy. There's going to need to be reinvestment in those hotels too, because they're getting worn out. And guests expect a lot because they're paying a lot of money. But I think, again, there's our new brands and our legacy brands can coexist. Guests love them all. And it just needs to get back to service and hospitality at some point, which is why we're here.
Excellent. Dupree?
I guess I'd end on a note on distress. I don't see a huge flood to the market from lenders foreclosing on assets and those types of things. I think in instances it will happen. But historically, in every other recession, that's where value has been created by either buying loans or buying assets that have been foreclosed on. In our world, which is mainly family offices who invest alongside our family, it has been, I think the opportunity is to focus on the equity side. And I think finding those partners who can't meet capital calls, finding those investors who've said, I've been in an asset for 10 years and I'd like to get out, I think that's where there's an opportunity to buy assets and get control of assets at a discount. Because I think that this manner of distress is probably more about fatigue. I mean, it's kind of like, if you're in a car wreck, you get hit. The impact it's the whiplash that kind of comes. I feel like COVID was the impact. Interest rate environment is the whiplash. And so now I think you've got enough folks going, man, I just can't keep doing this. And I think that's where we're going to see opportunities is going to those types of investors who are saying, okay, it's time for me to get out.
How do you find them?
Through other family offices, through syndicated investors. And our business is unique in that way. There are certainly a lot of institutional investors, but by and large, I bet most of the folks sitting in this room have syndicated partners who are looking at a capital call one way or the other, and they're going, I don't want to fund that. I think that's where the opportunity is for us to be able to say, hey, we'll fund it. We'll come in and buy that partner out. So that is where it is hand-to-hand combat, very unique. It's not going to come through marketed channels. It's going to be the old school way that this business has always worked, which is relationships.
Right, absolutely. Jim?
Listen, Glenn, we had a record year in 2023, so we are excited about continuing that momentum in 2024 and beyond. For us, we're excited about the potential that Hyatt Studios represents. But to Talene's point, we also think that there's plenty of room for growth in our traditional established brands. So for us, it's straight ahead, forge ahead.
Awesome. I also want to congratulate all of you for not saying that there's no clarity until after the presidential election, which I get tired of hearing every 4 years at all these financial conferences. So kudos on that. So what did we learn today? Number one, you should all follow me on LinkedIn, Glenn Hausman, or our no vacancy page. But more important than that, the relationship between owners and developers and brands are inextricably linked. It's very hard to be successful in today's operating environment without those cohesive relationships. Figuring out how to bring partners together to create products that are profitable, excite the customers, and help move everybody's businesses forward. That is absolutely the most important thing that I would like for you to take away. And while there are bumps between it, I think that the friction in the relationships between brands and owners does a great job of keeping everybody kosher, right? That way nobody will stray too far. So it's almost like a built-in system of checks and balances. So that's what I love about seeing this business. That's why I love that you're engaging owners, Taylene, and you're engaging owners, Jim. And I love that you folks out there are trying to put your imprint on either your own independent hotels that are soft branded or choose to be part of those branded families. Let's hear it for all these amazing people up here. That's awesome. And thank you guys for being here. Please rate our session highly. Thanks so much, and we'll see you next time.